The best RSI indicator strategy. Have you ever opened a chart, looked at the relative strength index, commonly known as the RSI indicator, and saw that the line was deep below the 30 mark? If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. Every textbook and YouTube video you have ever watched told you the exact same thing. When the RSI goes below 30, the market is oversold, which means it is too cheap, and you must buy immediately. So you confidently click the buy button, expecting the price to shoot upward like a rocket. But instead of bouncing, the price does something terrible. It keeps dropping and dropping and dropping. The RSI line stays flat at the bottom, and your trade goes deeper and deeper into a loss until your account is completely wiped out. You feel cheated, angry, and wonder why this incredibly popular indicator is constantly burning your money. The truth is, the traditional way of using the RSI, buying when it is oversold and selling when it is overbought, is the fastest way to lose all your money. In this video, I'm going to reveal why the traditional method is a giant lie, and I will show you the actual best strategies to use the RSI as a powerful support tool. We will skip the complex math and focus on simple rules, combining RSI with solid floors and ceilings, reading hidden market warnings, and using the middle line as a trend filter. If you are ready to stop burning your capital, hit the like button, subscribe, and let's get started. Part 1. The speedometer analogy, the overbought, oversold myth. To understand why the traditional RSI strategy fails, we must understand what the RSI actually is. Think of the RSI indicator like a speedometer in a car. A speedometer does not tell you where the car is going. It only tells you how fast the car is traveling right now. When the RSI goes above 70, it doesn't mean the price has reached a roof and must crash. It simply means the buyers are driving the price upward with massive speed and momentum. Just like a sports car can travel at a very high speed on a long highway for hours without crashing, a strong market trend can stay overbought above 70 for days or even weeks. If you try to sell or short the market just because the speedometer is high, you are essentially standing in front of a speeding car. You will get run over every single time. The exact same logic applies to the downside. When the RSI drops below 30, it means the sellers are driving the price down with extreme speed. Trying to buy here without any other reason is like trying to catch a falling knife. It is incredibly dangerous. So, how do we use this speedometer safely? We must combine it with external landmarks on our chart, our horizontal floors and ceilings. Part 2. Strategy 1. The double confirmation RSI plus, floors and ceilings. This brings us to our first highly reliable strategy, the double confirmation. Instead of trading the RSI speedometer blindly, we use it only as a backup filter to confirm our horizontal support and resistance levels. A support level is a price floor where buyers historically step in. A resistance level is a price ceiling where sellers historically step in. Here is how you execute this. First, we identify a clear, major support floor on our chart, where the price has bounced multiple times in the past. We do not buy immediately when price reaches this floor. Instead, we look down at our RSI speedometer. If the price touches our support floor at the exact same moment that the RSI drops below the 30 oversold line, we have a highly powerful double confirmation setup. Let's look at an example on this chart. The price is dropping toward our horizontal support floor. As it hits the floor, we check the RSI. The RSI line has dipped below 30, confirming that the downward sellers are exhausted and have run out of speed at the exact same moment they hit our brick wall. This represents a very high probability buying opportunity. By waiting for both the floor and the speedometer to align, you filter out nearly 80% of false RSI signals. Part 3. Strategy 2. The exhausted runner RSI divergence. Our second strategy is one of the most powerful warning signals in all of technical analysis: RSI divergence. Divergence is a simple concept that sounds complicated but is very easy to visualize. Divergence happens when the price of an asset and the RSI speedometer are moving in opposite directions. It is the ultimate way to spot when a trend is losing steam before it actually reverses. Think of this like an exhausted runner. Imagine a runner is climbing up a steep hill. They make it to a new peak, but their heart rate is extremely high, and they are running out of oxygen. They try to push further to make a slightly higher peak, but they are moving much slower now because they have no energy left. Even though they are technically higher on the hill, their speed has dropped significantly, indicating they are about to collapse. On your chart, this manifests as a bearish divergence. The price pushes up to make a new higher high, but when we look down at the RSI speedometer, the RSI makes a lower high. This tells us that even though the price is higher, the actual buying energy and speed have dried up. The buyers are exhausted, signaling that the upward trend is about to collapse. This is your warning to stop buying and prepare to sell. Conversely, a bullish divergence happens when the price makes a new lower low, but the RSI speedometer makes a higher low. This tells us that even though the sellers are pushing the price deeper, their downward speed and energy are dying out. The sellers are exhausted, signaling that a bullish reversal is around the corner. To make finding these divergences 10 times easier, you can use a free divergence indicator on TradingView, such as the CSRS indicator, which will automatically highlight these patterns on your screen. Part 4. Strategy 3. The 50-line trend filter. Our third strategy is my personal favorite because it completely changes how we use the RSI. Instead of looking for reversals, we use the RSI as a trend follower. To do this, we open our RSI settings, disable the 70 overbought line, disable the 30 oversold line, and only keep the 50 middle line. This middle line acts as our trend dividing boundary. When the RSI line crosses above the 50 level, it signals that the market has officially entered a bullish trend and the buyers have taken control of the speed. When the RSI line crosses below the 50 level, it signals that the market is in a bearish trend and sellers have taken control of the speed. This simple filter prevents you from making the amateur mistake of trading against the dominant trend. To execute high-probability trend-following trades, we combine this 50-line filter with another simple indicator, the stochastics oscillator. When we see the RSI cross above 50, confirming a bullish trend, we do not buy immediately. We stay patient and wait for the price to pull back, causing the stochastics to drop into the oversold zone. Once the stochastics is oversold within a bullish RSI trend, we buy. This allows you to join strong trends at the absolute cheapest price. Strategy 4. Don't trade RSI alone. One of the biggest mistakes beginners make is relying on the RSI alone. Just because the RSI is above 70 or below 30 doesn't mean the market will reverse immediately. In a strong trend, the RSI can stay overbought or oversold for a long time while the price continues moving in the same direction. Instead of using the RSI as a buy or sell signal, use it as a confirmation tool. Always combine it with support and resistance, market structure, or price action before entering a trade. When multiple signals align, your probability of success becomes much higher. Remember this simple rule. The RSI tells you momentum. The chart tells you direction. Use both together and never let one indicator make the decision for you. The road to consistent success. The Relative Strength Index is an incredibly powerful tool, but only if you stop using it as a blind reversal signal. By combining the RSI with horizontal floors and ceilings, reading exhausted momentum warnings, and filtering trends with the 50 line, you will trade with absolute clarity. If you found this simple guide helpful, please click the like button, subscribe to the channel, and leave a comment below. Stay disciplined, trade with the trend, and I will see you in our next masterclass. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you.